Cloud. All right, we are live. It is Wednesday, July 27th. This is episode 10, or we can call it, it's not really a show, but we'll call it session 10, Wealth Wednesdays. Matt, Natalia, how are you guys doing? How are you girls doing?
Doing great, my lad.
My lad, we got some things we got to talk about today. Today's a big day. Today's FOMC. They're going to raise rates today. So you're going to see a lot of volatility. You're going to see a lot of indecision in the markets. We'll review some things in the market that I think are pretty cool. And then we were talking about some current events that are happening all over the world that we think could be impacting stock markets and bond markets around the world. Let's take a look. Alrighty. So today we are going to talk about bonds. So let's look at the US Treasuries. Let's look at the 10-year US Treasuries, the yield on the US Treasuries 10-year. I'm going to delete all these drawings. All right. I think everyone knows by now that the yields back in the 80s were double digits. Okay, 10, 15, 20, 30%. Mm-hmm. And then I think everyone knows that since then, the yields have been in a downtrend. Right. So Matt, when yields are going down, what happens to the bond prices?
When yields come down, no one wants your old bonds. Or so everyone wants your old bonds, so the price of bonds goes up.
Yeah, the price keeps going up for the bonds, and essentially borrowing becomes cheaper, right?
Mm-hmm.
So as yields come down, borrowing becomes cheaper or less expensive. As yields go up, borrowing becomes more expensive. Okay. So let's zoom in to more recent history. Okay. Here we have pandemic, the bottoming of yields and that pandemic crash. Okay. And then the slow and steady gain of yields. Okay. On a percentage basis, and I think everyone was crazy when I showed this, yields have gone up by 800%. So there's been an 800% change in the yields. So how cheap or how expensive it is to borrow has changed. Mm-hmm. By almost 800%. Now we topped out at a very special number, 350 basis points. Okay. How much percent is 350 basis points? %.
Yeah. Okay.
Right. So we topped out at 3.5%. You can see right here. Purple line, 3.5. Okay, if you round up, actually hit 3.48, we round up to 3.5%. 3.5% is 350 basis points. The last time the 10-year traded at 350 basis points was back in 2010. Mm-hmm. Right. So we're the highest we've been in yields since the past 12 years. And since then, you can see on the chart, I'll zoom in. Once we hit 350 basis points, we started backing off. Okay. And since we started backing off, what have we seen? We've seen the stock market has stopped going down. Bitcoin has stopped going down. Lending and the cost of borrowing has gone down. Still higher than it was in 2020, but it's gone down since the peak earlier this year. Okay. Mm-hmm. And what's actually lining up right now is a really cool technical pattern. You can see it here. I'm just going to put a purple line right there. Put another purple line at 3.5, 350 basis points. So we have this type of pattern. Okay.
Mm-hmm. What's the name of this pattern?
This is called a head and shoulders pattern. Okay. And you can kind of see that right? You got a shoulder here, you got the guy's head or the girl's head, you got their shoulder. And what this right shoulder is indicating is that once price hit 3.5 and sold off, there was very little momentum or very little demand to take yields even higher. Okay. And you can see that because if you look here on the momentum oscillator, as price was forming that right shoulder, momentum never got positive, right? So we didn't get above the 0 line here. So you know that all this here was very little buying momentum compared to the buying momentum over here and over here, denoted by this histogram right here. Okay, so anytime you see a head and shoulders pattern or a potential head and shoulders pattern, you want to confirm that this right shoulder has little to no volume or momentum. Okay, and that's what we have right now. So what could happen? This purple line, the bottom purple line, is obviously an area that the market has tested quite a few times since April of 2022. And then before that, March of 2019. Okay. And price has come here like 1, 2, 3, 4 times. So if this level breaks, call it 275 basis points. How much percent is that?
Said 275, 2.75.
Right. Okay. If that level breaks, right? So if this level breaks, we could expect yields to come back down to about 2%, 200 basis points. Okay. And how did I get that? How did I get that? All I did is I measured the height of this pattern, right? So I measure the height of the total pattern, and then I copy it. So see how I'm dragging it? So I have the same thing. It's like the same shape.
Yep.
Then I bring it down to this bottom purple line, which in the head and shoulders pattern is called the neckline. Okay, the neckline. And that takes us to about 200 basis points, 2% on the 10 years. Okay. Let's go on the weekly. Yeah. And what I like about that is when you go to the weekly time frame, you see the 200 period moving average is kind of lingering close to this 200 basis point area. So as this falls, right, as the yields fall, you can see this thing slowly creep up. And then you have price and the 200 period moving average come together. And then that would probably be a time where the yields would stop going down and we can see them pick back up.
Gotcha.
Okay. So we just said that this has impact on everything. It's impact on the stock market, risk assets, cost of borrowing, etc. So let's bring up the S&P 500. And you can see on the S&P 500, we're kind of already close to that 200 period moving average. Okay. And what's awesome about that is price is close to the 200 period moving average on the weekly, while the 10-year is at a neckline, right? 10-year yield is at a neckline. We just showed you. So if that neckline breaks, what we could see is something like this in the stock market. Okay. As you get that rally in the stock market, you're going to see the yields come down. The yields are going to approach the 200 period moving average, right? The 200 MA. And by that time, the S&P 500 is up here. So what would be the move there? What would you do at that point? I'm going to put them up together so you can see. I'm going to get rid of the indicators just for ease of view.
Mhm.
Uh, yeah, okay. Okay, I will put the moving average on though. Sorry about that. You guys follow me right now?
I think so. Maybe give us Randy Dimitrios. Are you guys with me in search?
I am. I'm just on lead calls as well, so kind of not fully present, but
Okay, got that. Try your best. And come on camera if you can, guys.
Oh, where's my moving average? Oh my god.
I don't see it here, Serge.
Let me just put it up manually. Where'd you go? Length 200. Oh my goodness. Oh, 1 second, guys. I apologize. I just want to. Where's my MA? Where's my MA?
Are you able to get rid of it and bring it back? That bottom portion?
The bottom portion I can, just the moving average doesn't want to show for some reason.
Okay. That's my solution for anything technology. Just turn it off, turn it back on. That doesn't work. I can't help you.
Hold on.
Let us respond to the question. So what are you asking? You said, what are we gonna do? Oh, you're looking at,
I'm trying to put the S&P 500
yep.
and okay, I have it here. Okay, so it's done.
Okay, cool.
So at the top, we have the 10-year treasury bonds and the yields, associated yields.
Okay,
And at the bottom, we have the S&P 500. Okay. So what's very clear is as these yields have started topping out, as they were going up,
Mhm.
S&P started going down.
yes.
Okay. Then once the yields have topped out, the S&P stopped going down. Okay, you can actually see that we bottomed. I'm zooming in. Okay, we bottomed here,
Close to the moving average.
close to the 200 period weekly moving average, right? So this is the average of the 200 previous weeks. That's the price right there. But you see how we went up and we took out these previous lows here on the left.
Yes.
You see that? That's indicative that we're probably going to head higher. Okay. So if we head higher on the S&P 500, what am I going to expect to see on 10-year yields?
You think they're gonna come down?
Yeah, they're going to come down. Right? And I'm going to expect them to come down to maybe 200 basis points, 2%. It's right here. For all my circle, I'm drawing these circles. Okay.
Mm-hmm.
By that time, I think the 200 period moving average will be up here for the 10-year. And then on the S&P 500, I could expect it somewhere up here.
Mm-hmm.
Okay. Now, if this happens, so fast forward, 10 years trading up here, stocks are up here. If this happens, what would you do?
I'm looking at the,
Would you tell your client to go all in on stocks in here?
no,
Okay.
I wouldn't tell them to sell. Cause I see that in the S&P, we'd be up around the all-time highs. Not
Right.
much above, about the same. And for the yields, it would be at that 2%, which we've been lower, but we've only been lower in pandemic times.
Yeah, a little bit in 2012,
Yeah,
a little bit in 2016. We've been there, just we haven't stayed there for that long.
yeah. So we could go lower and the stock prices could go higher, but I
Yeah.
wouldn't risk it. And stock prices could come down, but I wouldn't really sell. I don't know. What would you do, Serge? I'd probably have them
Well,
Stay
I
put.
guess the people looking to invest, I would encourage. I'd say now is probably a good time in a long time to start getting into stocks, right? Growth stocks, especially if inflation has peaked. We don't know if it has, but especially if it has, right? So that's kind of the advice I would give. Maybe I wouldn't, depending how much money they have, I don't think I'd be really recommending dollar cost averaging. If they have a long time horizon, I'd probably say just buy right now.
Are you talking about now? Or are you talking about
Well, I guess now
at
and
that point?
then. So
Okay.
at that point, I would say if you're going to invest more, don't, or dollar cost average. Or if you have some type of expenditure, if you think you need that money for something, you sell. You get out, right? And deal with what you got to deal with, and wait for yields to go back up, and wait for stocks to go back down, and then look to get in. Okay. That's what I would do. That's what I would do based on what we just talked about. Okay.
Gotcha. Demetrios said something in the chat. Demetrios, you want to share?
Sorry guys, I don't really see the chat.
Do you want to share with us?
Monkeypox has been declared a pandemic by the WHO, so perhaps we will see 2% lows as we're going into another pandemic. Yeah, like if they shut down the economy and stuff to deal with the pandemic, they'll need interest rates lower to deal with that, and that could be a catalyst to get us back to 2%. I think we can get to 2% without something like that, though. To be honest.
Yeah, and that inflation would probably be. I mean, we saw for COVID the stock market inflated like crazy, and then now we're seeing this crazy come down, and a lot of very negative byproducts of that. And when you're ready, Serge, I have the interest rates pulled up for the G20 countries. We could take a look at that, unless you wanted to go somewhere right now with all this up.
I just want to look at Bitcoin real quick, and then we'll look at interest rates, right? Yeah, like interest rates have gone up. Are you looking at interest rates or inflation rates?
Inflation. Did I say interest? I meant inflation.
Yeah, you said interest. It's okay.
My
Yeah,
bad.
inflation rates are crazy everywhere. I just want to point out that Bitcoin has also been kind of like with yields. As yields have topped out, Bitcoin has stopped going down. Okay. So just like the S&P 500, just like other risk assets, if we have more pressure on yields, we could expect Bitcoin, to do a ferocious rally. And potentially, the level I'm watching that I think Bitcoin really needs to break is this level right here, about 30,000. Right? Like I think if Bitcoin breaks 30,000, we'll probably head higher.
Yep. And where are we at right now, Serge? On this day?
Yeah, we're
July.
trading at 21,000.
Yeah, we've been around there for what seems like a while. 20,000 US.
Yeah, like dude, we've been there for the past like 5-6 weeks.
Yeah. I bought some Bitcoin at 20,000,
Nice.
expecting it maybe going lower and buying more then. And then I'm looking back a couple weeks later, I'm like, it's still there. This is some hang time.
Well, listen, like if you go back to the summertime of 2021, you can see how long we were in this sideways consolidation, right? This is all week.
Yeah.
This is weekly time frames. So 1, 2, 3, 4, 10 weeks of sideways consolidation.
Yep, that's right.
We're about 6-7 weeks into sideways consolidation. Mind you, we've had a much bigger drop. We've had a much bigger drop since then. So this consolidation could be much longer than this consolidation over here.
That's
bigger drop, longer, more consolidation. Small drop, less consolidation.
Yes, that last consolidation period, I had people asking me, what are you doing? What do you think is going to happen? And what happened was it makes a lot of sense, but I wasn't sure. I thought maybe it's going to go up, might come down for a bit, probably a good time to buy. Now I don't know. I'm sold that it's a good time to buy because it is much lower and we're seeing that same point. Yeah, then it went up and some people thought it was going to keep going up, but then it kind of reversed.
Yeah. I think it is the best time to buy because when you zoom out, it's going to delete all my drawings, okay? When you zoom out,
Gotcha.
you can see relative strength index here, right?
Mm-hmm.
It's basically showing you how expensive or how expensive, how inexpensive a security is or an asset is.
So you're saying it's undervalued right now?
Yeah, like I'm gonna put a horizontal line here. So in my opinion, we haven't been this undervalued since 2012,
Mm,
but the price is much higher,
yeah, that's right. Things have
right? So the
changed.
market's saying, like, given the maturity, the time that's passed, the price that it's been, the price that it's at now is actually a better time to buy than 2012, or since 2012, I should say. Sorry. So I think it's cool.
Wow.
Matt, that's it. That's all I have for market review. I think that's enough to give people an
Awesome.
idea of what's happening now, what could be happening, and kind of what we're expecting.
Yeah, maybe we'll touch on a few news headlines and then we'll dive into our main topic.
Right.
I'll
There's
bring
been a
up
lot of bad,
the
like,
been a lot of
yeah,
bad news.
yeah, there's been a lot of bad news. Like we were just talking about China. We're talking about tanks in China, war in Ukraine. Looks like China's sending, is doing military exercises in Russia. Right. So this is from Moscow here.
Yeah, that's
And so I don't. Oh,
it
this
was
is old though.
some of the stuff, yeah, you'll see is old. They actually had Chinese soldiers do winter warfare training in northern Canada just a couple of years ago. And now we're kind of thinking, okay, what were they training for? You know what I mean? Where is it cold? I don't know. But some of us have probably seen, I think Dimitrios has seen the tanks in China right there. That's the article that actually had the video. If you click that one, Breitbart, they actually showed the video that you can play, which is kind of disturbing, seeing tanks in the street. And China seems to be saying that it is for war games. And then we're hearing some issues with the banks. And Sergio, you're talking about boycotts for mortgages.
Yeah.
It's
Yeah.
almost unheard of here.
Oh my goodness. This is 19 hours ago. And yeah, we have people not wanting to pay their mortgages, suppliers defaulting to some suppliers to defaulting developers such as Evergrande are refusing to make loan payments. Right. So there's a lot of stuff happening in the world, you know.
Yep, we've
A lot of stuff
seen.
happening. But there's been a lot of bad news for a while, and I feel like a lot of this bad news is kind of already baked into the cake.
Yeah, and
I think
you
so.
know, yeah, I think you're right. And I mean, are we going to be? I think there's going to be a lot of fear. I think there's going to be a lot of fear. There's a lot of talk of recession and depression, and there's going to be opportunities that we have to look at. Liquidity might be a good thing, but yeah, news seems to be very, very, very bad. I think prices are going to get a little bit lower, and might be a while before things get better. What do you think on that front, Serge?
When you say prices lower, like prices lower on what assets?
Risk assets specifically.
Yeah, they could. I mean, we just saw, right? Like to me, they look like they're going to go higher and then lower. Like that's what I expect.
I would think lower than higher. They're going higher than lower. Okay.
Yeah, I think higher than lower. If there's any positive news out of Russia and Ukraine, that would be very good for risk assets.
Yeah,
Nothing
and that could.
big right now.
Yeah, and I'm hearing negotiations are not being done.
Right.
But I'm not hearing escalation either. So I don't know which way that's going to go. But I can show the inflation rates and whatnot, and then we can switch over to the main topic. Let me see here. So G20 countries. I was a little surprised. Well, not really surprised. A little surprised about Saudi Arabia. Japan and China, not so much. They have the lowest. Their inflation rate for, I believe this is 2021. Let me double check. It doesn't say. Okay, this is reference of June 2022, actually.
It's all right.
I was trying to find 2021. So this is more recent to this year. Their inflation rates kind of what we'd see on a normal year in Canada. And then we have some other countries here. Canada, they say 8.1. And then we have United States, 9.1. Very, very high. But luckily, we're not in these countries. There's Russia at 15, and then a huge jump, Argentina at Turkey. And I'm curious to see, I just saw this morning, so I haven't done much looking, but what's going on in Turkey? That's just insane. That's like, I think damn near hyperinflation, reminding me of what happened with Venezuela. And I don't know much about Argentina or Turkey's economy and what it's based on, but yeah, sometimes we forget about how impactful inflation is until it gets out of control.
Yeah. Yeah, I don't know the cause, to be honest. Like Argentina, Turkey, they've had like they've always kind of had, not always, but it's like this isn't new. Like I bet you if you looked at like 2021, 2020, 2019, you go back in history, you'll see that Turkey and Argentina have had these problems.
I know Turkey specifically has always had, in the last 5 years at least, they've had a higher inflation rate. So they're going to be impacted more than anyone for this. And then the video that we were referring to of the tanks in China is right here.
Is that the central bank? What is that big window?
I don't know if that's the central bank or just a bank branch.
That's a video showing tanks lined up on the road in China. It's shocking the internet with over 2 million views. Now, tanks are on the streets in China out to protect the banks. This is because the Henan branch of the Bank of China is declaring savings in their own branch are now investment products and cannot be withdrawn. This clip shows a long queue of tanks preventing locals from reaching the bank branch. And as the camera pans right now, the tank queue is seen covering the entire block. The locals look agitated, but they're forced to wait because of the presence of armed vehicles.
So pretty crazy to see that. And then we have BRICS, which is something that we could talk about in the next couple of sessions here. This is an alliance between Brazil, Russia, India, China, South Africa. And Sergio, I believe you said Saudi Arabia is expected to join as well, right?
And Turkey.
And Turkey. Okay. And then I've seen some videos of farmers, Dutch farmers in the Netherlands. I had to look up Dutch farmers, where are they from? Dutch, Netherlands. There's been government regulation on the amount of livestock they can keep. I believe it's not actually livestock, it has something to do with emissions. And the farmers are in the streets, massive protest, tractors, a whole bunch of stuff going on there. Some violence, police and protesters getting at it. This just adds to the fear. When we see this sort of thing happening, if their government's doing it, Canadian government's doing it as well, there might be a weird shift in how farming is done, and the market's going to react to that, how it reacts to it. And then I did want to talk about bail-ins. Sergio, what do you know about CDIC bail-ins?
What? What's the first thing?
CDIC.
Oh, yeah. Okay.
Yep. Bank accounts are insured up to $100,000 in Canadian banks with CDIC.
Yeah.
But if that insurance takes effect, there's a run on the banks. They do what's called a bail-in.
Yeah. They turn your checkings into stock.
They turn your checking account into bank stock.
Yeah.
And I believe it's common shares. And you'd imagine at that time, the common shares of the bank would be plummeting. and they use your cash to help out their stock. So we all like to know that our money's insured by something. Insurance companies have a different system, but the bank system, CIC, doesn't get questioned a whole lot. That kind of rung true for me, and maybe we could pull up a document here, maybe next session, just to kind of show what that looks like. There was a bill that was passed for that. I don't know if you can find it real quick while I'm talking. But yeah, that sounds similar to what's going on in China. They're not allowed to take money out of the bank. It's now an investment. So let's do some digging and see if they're doing a bail-in there, because that kind of gives us some headway to prepare. I'm not saying it's going to happen here, but it's good to be prepared, know what would happen if it came and struck us at home.
Yeah, there's actually, if you go to CDIC's website, they talk about it.
Yep, that's right.
How bail-ins work. What happens in a failure?
What does it say there? And that's from CDIC, right?
Yeah, that's from Canada Deposit Insurance. There's a bunch of literature here. We can look at. I can share my screen, but
Go ahead. It might take us a while to find some concrete, so then we might have to talk about this at another time. But I definitely think it's important, and not enough people understand how this works. The actual bill that allowed this to happen, I believe it's Bill C something, C71 maybe, not 71.
hold on, it's probably here, my love.
Bill C15, maybe. If we read that bill, it gives us some. Bill C15, it says updates to the bail-in. So everyone got mad at the bailouts that happened in 2008. This is not a bailout, it's a bail-in, totally different. Not really. So we'll see what
Look,
happens.
You're saying what's excluded: deposits, secure liabilities, eligible financial contracts, structured notes. While they are not subject to conversion under the bail-in regime, NVCC instruments are subject to conversion pursuant to their contractual terms and would fully convert into common shares prior to the bail-in conversion of senior debt into common shares.
Mhm. And it says what's not eligible: deposits, savings account, including
Yeah.
checkings account. Hold on, deposits are not included.
Yeah, that's what they're saying. They're saying they won't take deposits and convert them into common shares.
So what is included?
Says right here. So we got long-term debt, long-term unsecured senior debt that is tradable, transferable, and issued by DSIBs.
Mhm.
Preferred shares and subordinated debt that are not NVCC will also be eligible for a bail-in conversion.
Wow.
I don't know what NVCC stands for though.
Maybe we'll talk about this in another week.
I don't know how
Kind of
relevant.
dive into it a bit.
I don't know how relevant it is, right? Like, I think, like bank runs happen and it can happen here, right?
Yep.
But like, I don't know. Like, I think people know that they should have stuff outside the banks, right? I hope people know that. Like, they shouldn't
For
have
sure.
everything. Like,
For sure.
they should have everything with like one, like you want to stuff. Yeah. So I don't know.
Yeah, I
No.
just you go to a bank, you see they have that little sticker, it says CDIC, you're protected. What does that really mean? It'd be very interesting to dive into. But in other news, we had 4 world leaders step down and resign. Boris Johnson in UK, Sri Lankan leader, France, and one more, Italian.
Yeah.
Very crazy. I don't think that's ever happened before. Not that I know of. I've never seen that happen. And it seemed like no one talked about it. It was kind of announced and then that was it. I think it'd be pretty crazy if President of the United States or Canadian Prime Minister it's close to us that we'd notice, that would make a huge difference. But I'm not hearing a lot about what's going on in those countries, who's going to be stepping in, all of those things.
Yeah, the only thing that doesn't completely surprise me about the resignations
Yep.
is I think like a lot of world leaders fail. Like I think a lot of people see like failure when it comes to COVID.
Yeah.
And
Yeah. People are
Right.
very upset for sure. It's
Yeah.
just not all the time you see someone voluntarily step down. I'm hearing that they were going to be pulled out. There were people that were angry, so they had to resign. I don't know the whole story, but I think that kind of adds to some fear. Unless maybe you live in those countries, you know what? No, we're in good hands. Someone else is going to take over. That's going to be a better leader. I know Boris Johnson was in for quite a few years, so it's kind of a shock to see that happen. And I know the Sri Lankan prime minister or president, his house was raided by protesters. I've seen videos of that, bunch of people just running in there, and he fled the country. So absolutely insane to see that happen.
Crazy. Yeah, it is very insane. A lot of stuff's happening. It's weird.
Yeah, so a lot of stuff. Shinzo Abe, the former prime minister of Japan, was assassinated out of
Right.
office. I believe he was campaigning to get back in office. So very crazy. A lot of stuff going on right now, and markets are down. Dimitros says
Yeah.
3 days before elections. I didn't catch that part. So 3 days before elections, someone assassinated him.
Crazy.
Yeah.
Absolutely crazy.
And his party overwhelmingly won 3 days later. Wow. Okay. He would have been, so that tells me he would have been prime minister if that didn't happen. So that's insane.
Yeah.
So that's kind of an update there. Let's dive into the actual presentation for today. We're going to dive into bonds and dig in on a deeper level. We've seen these rates fluctuate. So how bonds work,
Yeah, I
if you
think-
want to buy them.
Yeah, bonds are important.
Yep. And I think they get overlooked.
Like we talk about them briefly. We talk about yields, and treasury bonds, and what it means if interest rates go up, what happens if interest rates go down. Okay, so we're just going to go into a little bit more detail, talk a little bit more about them, have you guys get more comfortable talking about them, and just know like they're in most people's portfolios, right? So if you're invested in a pension fund, if you have a RSP, a TFSA with traditional funds, instruments, you are in the bond market. Okay.
Mhm.
So we're going to talk about, just going to do an overview of bonds, what they are, how they work, basics. Okay, I'm not a bond expert, but I do follow them and I do understand how they impact the economy and us and what we can buy and what we can't buy. Okay, so why do bonds matter? And then how can you apply this or these concepts in your business? So how can you talk about this stuff? Okay, so what is a bond? Okay. Now, please don't fall asleep. All right. This does get exciting. Okay. And even if it doesn't, stay awake. So very simply, taken from Investopedia, a bond is a fixed income instrument that represents a loan by an investor to a borrower. Okay. So typically corporate or governmental. A bond could be thought of as an IOU between the lender and the borrower. That includes details of the loan and its repayments. Okay, so the bond market is essentially a big debt market. It's a big lending market. Okay, very distinct from an equity market. Right, you got debt markets, you got equity markets. Everyone focuses on equity markets because it's exciting and that's what's on the news.
Mhm.
The bond market is a much bigger market, and there's tons of people that are speculating, investing, trading, and in the bond market. And then there's plenty of people that aren't doing any of that, but need to be involved in the bond market to fund operations, right? Commercial banks, central banks, you know, big companies, right? So yeah, what was I saying?
Sergio, you falling asleep here, man? Come on.
I was like, what was the point of what I'm saying?
Yeah. So we got lenders and we got people that buy up the debt, pay the interest on it.
The reasons why people are involved in the market, right? That's what we're talking.
Okay.
Yeah. Okay. I don't know. This is a typo here. Okay. The biggest players in the bond market, okay, so the biggest participants are going to be government institutions and big companies. Okay, so think government of Canada, think United States, think governments of Saudi Arabia, Russia, China. Okay, they all are doing this stuff. And then think of the biggest companies like Apple, Microsoft, I don't know, pick a big company, Boeing, right? There's tons. They are all in the corporate bond market. Okay. So what do government institutions want to do? They want to borrow money or invest money, or they want people to buy their bonds. They want to issue bonds to people like me and you, central banks, Apple, municipalities, foreign governments. Government of Canada wants to issue bonds to those people so that government of Canada can receive a loan or money to do stuff. Okay, bunch of stuff. Pay interest on their debt, invest in military, pay for QE, do these fiscal programs, whatever. I don't know. There's tons of reasons why governments will need money. Okay, a lot of it is actually when it comes is infrastructure. Okay, so people like you and I will lend money to the government so that they can build infrastructure. Once that infrastructure is built, they can raise taxes. They got more efficiency. They got more companies. They got businesses that want to move there. And now all of a sudden, governments are making tax revenue or more money. Okay, this money will go and pay back the people who lent that money to the government. Hopefully. Okay, and then that's how these people get paid. Right. So the bond market is a very big way for governments to function. In fact, they don't function without bonds, without the debt market. So now you can see why the debt market is so big. It's not just Canada who needs it, it's all the countries around the world who are participating. Similar to governments, corporations like Apple and Google and Amazon and Netflix, they also want people like me, you, governments and commercial banks to give them money or lend them money, right? Because for them, they're like, hey, we can use that money to make our companies bigger, better, smarter, stronger.
Mm-hmm.
They invest in their companies. Hopefully their companies do get bigger, better, faster, smarter, stronger. And now they have the money to pay back to their investors. Okay. Now there's a lot of times where these corporate bonds, these people, these corporations, and sometimes even governments, where they just can't pay that money back. And that's called a loan default. Okay. And there's impacts to defaulting on loans. When you start defaulting on your bonds that have been issued, that you borrowed, your credit rating goes down. Okay, so now Canada does not look like that's not AAA. They're maybe now AA or A or maybe in the B's, right? So credit rating can go down. Your stock can go down. All right, people say, oh, wait a minute, Apple couldn't repay those bonds due on August 2022. If they can't pay those bonds, I might as well sell my equity. I'll get rid of my equity in a company that can't pay back its debts. Okay. The price of the bonds will also go down. Okay. So bonds, just like a stock, have a price. Okay. So, people lose confidence in the companies, people lose confidence in the government. They can lose their privilege of collecting funds and investing. Okay. And, inside of that, you have municipal bonds, you have provincial bonds inside the government, corporate bonds. Well, it's just really just corporates, right? Small businesses, medium-sized businesses tend not to issue bonds on a tradable market, but they may issue some type of debt, or they may ask for some type of debt that has bond-like characteristics. Okay. What are the bond-like characteristics? Let me go back before you just do that. What are the bond-like characteristics? Okay. There's an interest rate that needs to be paid. Okay, just like in a loan. Okay, there's the amount loaned, right? So how much was loaned? What else? There's a maturity date. All right, when this loan is due, very important. Okay, and then on tradable, this would just be for a loan, right? On tradable bonds, like corporate bonds, there's also a price. And that's when the bonds trade on secondary markets. Okay. So you got percentage paid, you got the amount loaned, you got your maturity date. Just like any loan. You go to corporate bonds, the only thing that changes is there's a price now, and it's tradable on the secondary market. Okay. Very cool. Let's look at deeper dive into the bonds. Especially government bonds, okay? So how do economies work? All right, as you know, or hope you know, governments do not create their own money. Okay? They work with central banks. Okay? Governments team up with central banks. Okay? The central banks then team up with commercial banks like CIBC. TV. Okay. And then then whatever the banks do with the central banks, what trickles down goes down to the people. Okay. So government says, hey, we need money. We need to put money into the economy. They call up the central bank. The central bank says, okay, how much do you need? They say, hey, we need $1 trillion to deal with a pandemic. Central bank says, okay. We'll give you the money, give us the bonds. You got to pay us interest. Issue us bonds. We'll give you interest. And take that money and spend it. Give it to the banks, give it to the corps, put it in your social welfare programs, put it in your vaccine programs, whatever the hell you're doing, okay? And that's how governments operate. Then whatever goes to the banks, commercial banks, CIBC, then trickles down to the people in form of investments, interest rates on the loans, access to loans, et cetera, et cetera. Okay.
Yeah.
Yeah. So it's you know, it's like power to the people, right? It's like, yeah, we get all this trickled down to us, right? It's how the system works. We're happy. We don't got to do anything. Okay. You know, hopefully people benefit from this. We don't know if they do, but that's how the system works. Government needs money. They work with the central bank. Central bank works with the commercial banks. And, you know, commercial banks work with the government sometimes too, right? The banks may also buy the bonds that governments want to issue. And, you know, banks can use money on deposits, reserves to buy those bonds, or they can create their own loans to buy those bonds. Many ways for the government to get money, okay? So interest rates, okay? What do they mean? We talk about interest rates all the time. We just talked about the 10-year. Its interest rates, you know, topping out at 350 basis points and now coming down. Main things to know is higher interest rates equals lower bond prices. Okay. Higher interest rates on bonds equals lower bond prices, which typically equates to more expensive borrowing out there in the world, more expensive borrowing on your lines of credits, your mortgages, credit cards, personal loans, car loans, margin loans, all the types of loans out there will be more expensive if you see lower bond prices. Okay. So the opposite of that is lower interest rates on the bonds. Okay. And lower interest rates on bonds equate to higher bond price, which ultimately equates to cheaper borrowing costs. Okay. Cheaper borrowing costs means your line of credit's cheaper, your mortgage is cheaper, your credit cards are cheaper, your personal lines, your loans are cheaper, your car loans are cheaper. What does that mean? More demand. More demand for stuff. Okay, you got more demand for stuff when you got lower interest rates, and then you got less demand for stuff, high interest rates. How am I doing on time, Matt? Oh, we're
You
almost
got
done.
7 minutes. Yep.
Okay, we'll finish five. We're gonna finish in 5 minutes.
Okay.
And you got less demand. Okay, so what did we see as soon as Bank of Canada, the Fed started jacking up interest rates? What did we see? We saw the price of homes come down. We saw the price of stock market come down. Price of a bunch of stuff came down in price.
Mhm.
Okay, even commodities and Bitcoin. Why? Because now it's going to cost me more as a consumer, as an investor, to borrow more to buy that stuff. Or maybe now I have other debt that is maturing or that has gone up in cost, and now I need to sell risk assets to deal with that. Right? So that's a primer on interest rates. Super important. You want to know what the interest rates are at the central bank, and at your 5-year, 10-year, 20-year treasury bond prices for Canada or the United States. You want to pay attention, and you want to have a good understanding of where things are going over the next 6 months to a year to 3 years, and where do you think things are going over the next 3, 5, 10 years, if things are going up, if things are going down. Okay, you can make better decisions. All right, so let's just talk about some some conclusions, big takeaways. Okay, so the bond market is much bigger than the stock market. Okay, so if you're learning about the stock market, you better start learning about the bond market. The bond market clearly impacts the stock market. Okay, and it's the bond market that impacts the stock market. It's never really the stock market that impacts the bond market. Okay, so just with that right there, you probably know that probably you better understand this one first, then before you start understanding this one. That's what I think. Central banks and governments use bonds to run the economy and initiate many economic programs and policies. I spelled initiate wrong. Okay, I know how to spell. Bond market. Right? Bond markets and their associated yields are typically forward-looking indicators for investors. Okay, now we just talked about this when we did our first half. We talked about how we're using yields to get an idea of what's going to possibly happen in the future. Okay, and if the thing is this, if you see yields on a 10-year, let's say at 2.5%, okay, mortgage companies, lenders, they're not gonna, the yields are gonna go higher before the actual borrowing costs will go higher. Okay, so if you see the yields at 3% and they've just been there, like they just got there today, then what you could expect is that maybe 2 to 3 weeks, maybe a month lag time, then you're gonna start seeing the price of borrowing go up. So by actually following yields, you can be ahead of these changes in borrowing. It's not like the banks aren't like, oh, the yields are at 3.5%. Automatically, we're going to adjust. No, it takes time. It stays there for a bit. Then they start making the adjustments. And then you're like, oh, shit. The cost of borrowing just went up. Even though the yields have already topped out, they've actually started going down. So you'll start saying, oh, yields are going down, but the cost of borrowing is going up. Give it a bit. The cost of borrowing is going to come down again. It's lagging. Okay. And a healthy bond market is indicative that the underlying economy is strong. Okay. If people are buying your bonds, you have no problem selling your bonds, interest rates are stable. It's a good sign that your company, your country is doing pretty good. Right? So you want to pay attention to that. Look, where are the countries that have strong bond markets? Where are the countries that have weak bond markets? And can that change? Is that going to change? Right? It's not static. We could have a weak bond market turn into a strong bond market. And we could have a strong bond market turn into a weak bond market.
That's right.
Okay. And that's really it. Okay. Super basics, you know. I think we gave you guys just a brief overview, interest rates, bonds, how they're used, who uses them, why, how we use them to look at strength of the economy or to get a gauge on where the stock market's going, where risk assets are going, where real estate's going. And yeah, I want you guys to learn more, like keep learning about this stuff. I am. And that's it. That's all I got for you guys.
Awesome. Real estate. That's something we should look at next, Serge.
Yeah. Yeah. We gotta, you know, highly related to the bond market, right? Highly related to the bond market. So I don't know. That's the more you study the bond market, the more you get a feel for the real estate market. Right. So
Cool, yeah. All right.
that's it.
Hey,
That's all, guys.
Question
Any
for you guys. When you mentioned real estate there, Matthew, how in depth are you guys speaking about real estate as an investment? If that's what I heard right.
We'll see how in depth we go. I know prices have gotten insane. There's probably gonna be a cool off, but yeah, if we do dive into it, I'd like to look at really just the supply side of it more than anything. Demand, what drives demand? What's slowing down supply? What's going on with the prices? Like that's kind of where I'd like to look. What do we use, Serge? What would we be diving into?
I don't know. Like just to start, I think we'll go over basics of real estate, right? Like different kinds. Different kinds of real estate, different ways to access finance into real estate. When does real estate do well? When does real estate do poorly?
Yeah. Would
yeah.
you be talking about Airbnb at all? Would that be part of that as well?
I don't know if we would talk about that like that. When you start, like we could, like I think what people need to know about when they Airbnb a property is now it's not passive income. Now you're dealing with active income,
Right.
and you're paying full tax on active income. Right, so we could talk about that stuff.
Yeah, that's kind of like specific, like micro. Yeah. That's one way to make money with real estate. Yeah,
right.
We're probably not going to get into that.
Yeah,
like how to do it. It is a thing, but we'll probably be talking about real estate as an investment in the sense of how we talk about the stock market as an investment, a vehicle.
Would we talk about the REITs then as well? Is that something that would fall into that?
Yeah, we could talk about REITs.
Yeah. Yeah, cool.
Yeah. There's a lot that are publicly traded.
Yes, I like this. Like if you guys have requests, thoughts, topics, like just things that you think are relevant to make you a better advisor, better investor, like
bring it our way. Like we'll like to talk about a bunch of everything. Sometimes we're running out of ideas. So yeah, bring it our way.
Well, I had one question for you guys, and I wasn't fully engaged today, and I apologize for that. So I was on calls. But one thing, I don't know if it got mentioned or not. I know I reached out to you, Matthew, about it, just with the news with the currency in China and Russia. Just wonder how that plays a role with the stock market and what opportunities may lie with that, because they're basing it on minerals, right? The gold and anything that's coming out of the ground, basically. That's what their currency is built on. And then the US, obviously, it's built on nothing, just ink and paper.
Yep.
So I just wonder if we'd touch on that and what opportunities may open up for us as investors or advisors.
Yeah, that's awesome. I brought up to Sergio before we hopped on. Like we talk at 10:30. So we talked about that. There were so many other things to talk about. We didn't mention it on the actual session. But we did want to talk about BRICS, which is the alliance between Brazil, Russia, India.
Okay. Yeah. We talk about. Let's talk about it real quick.
Yeah, let's talk about it real quick because they already have this alliance going on, Russia and China. And I think North Korea has some deep ties to China that no one really talks about. I don't know what they have involved with Russia. But yeah, that's going to expand. There's going to be some other alliances on the eastern part of the world. But what do you have to say about that, Serge?
So all I can say, Randy, is when that alliance actually happens, once that becomes a reality, the US dollar will probably make, like, you see how the US dollar has been going up pretty much since 2008? I don't know if you can see the screen, Randy.
Yeah, I can see it. Yeah.
Okay, so we've been pretty much going up since 2008, which is what, 14 years. Okay.
Yeah.
So if that agreement comes into play, I think we can see a downtrend in the US dollar for the next 5 years, 10 years, call it. That's what I think. Because Saudi Arabia is thinking about joining that team, and they have the deal with the US dollar, or with the United States. And that deal that they have with the United States is the reason why the US dollar is the reserve currency of the world. There's no other reason why it's the reserve currency of the world. They have it because of that deal with Saudi. So the Saudis change that deal, we can see the US dollar, get significantly weaker over the next 5, 10, 15 years. Okay.
So with the war and all that stuff, has that kind of played a huge role in what's happening in the stock market?
Has that played a huge role? Yes.
Like, has it played a role at all? Like, has it changed anything because it brought stocks down or brought things up?
Yeah, they're saying that the war has caused commodity prices to go up, supply chains to be dismantled, people not wanting to invest. They see the US sending all this money for the war. People are like, I don't know if I want to invest in the US. You know what I mean? So yeah, it has if you start seeing any type of peace talks, like the opposite of bad news when it comes to the war, we will see a big move in the stock market, I think.
Like
a big.
Seems like there's a lot of stuff going on too, right? Like, they're talking about, like, Europe is gonna have like some kind of big change as well too. With the leaders, right? Because of this. Is that something like you've been hearing as well, Sergio?
Well, I've just been looking at the euro, right? Like, if you look at the euro against the US dollar, right? Like, we almost hit 1-for-1, where $1 buys €1.
Yeah.
Right. Oh. And we haven't been there since 2002. 20 years. So we're hitting all like these historical, like, significant levels. But things are getting, like, the news has been so bad. The dollar's been getting so strong. The stock market's been selling off so hard that this is bound. I think it's bound to, like, change, and just, we're close to the dollar top. Like, if you look at the euro here, I have something saying that's, look at this, headline CPI number. You see that? You see where I wrote that? Headline CPI number? That was the day, I'll show you. This was the day right here where the United States came out and said, hey, we had a 9.1% inflation rate. So if that was peak inflation for the United States, this is the bottom here, and we're going up. Because even though they announced that number of 9.1%, the euro got stronger. Okay. So, and if inflation gets worse in the United States and political tensions get even worse in the European Union, then we could see the euro come back down to here, maybe 85 cents. Right? That's all I'm seeing. I'm not seeing like I'm looking at a potentially weaker euro or stronger euro. And I'm just well aware of where the euro could potentially go.
Yeah. Is there any indication, or could it be possible that the euro could become non-existent?
It's possible, yeah. I don't know if that's going to happen anytime soon, but it's possible.
Possible, not likely?
Not likely.
Okay.
Yeah, possible, but not likely. Exactly. All right, guys, I gotta hop off. I got a 12:30. I gotta prepare.
Okay.
This was
Okay.
awesome. We're gonna be sending out the recording shortly. Let people know what they missed. Okay. If you have any questions or any suggestions, just literally just reach out. All right.
Reply to the email. Reply to the email. We'll all see it. Let us know. Real estate would probably, maybe not the next one, but the one after, because we have one in the chamber for next session. We'll have it coming down the pipeline.
Sounds good, fellas.
All right, guys.
Cool.
Have a good one. Okay. Cheers.
See you guys.
Take care.
Thank you.
Enjoy your Wednesday.
You as well.
Have a great one, guys.
You too.
Good one, guys. Bye.
Bye.